Hello, everyone. Thank you all for joining today's webinar. My name is John Pasalis, president at Realosophy, and I'm joined by Urmi Desai, our content officer at Move Smartly, who's going to be keeping an eye on all of your questions as we move forward. So for those of you who haven't joined our discussion before, really what I like to do is host these discussions to walk through some of the high level trends in Toronto's housing market, but more importantly, talk about some of the on the ground trends and some of the trends in the data that aren't as obvious that are impacting the dynamics that we're seeing on the ground. Because I think the more we understand what's happening, the more informed decisions we can make, whether you're buying a home or whether you're potentially selling a home. And that's really what we're going to try to talk about in today's discussion. As I said, if you have questions, please feel free to post them in the chat. Urmi's going to be keeping an eye on all of your questions. Here's a brief overview of what we're going to go over today. We're going to be talking about sort of the market update for the housing market and for condos separately. I'm going to chat a little bit about some of the on-the-ground trends that we're seeing and I'm seeing, in particular, prices appearing to start to level off right now due to low inventory. I want to unpack why high interest rates alone are not why Toronto home prices are down 23%. I mean, I think this is an important point that is going to help us understand the dynamics we're seeing today and what to look for in terms of red flags in the future. I'm going to chat a little bit about why there are so few homes for sale on the market and why investors aren't rushing to sell. Normally, markets that are really dominated by investors, the way Toronto's is, usually see investors rushing to exit the market when prices are cooling, and we're not seeing that right now. So that's kind of a little bit about what we're going to go over today. Anyone, like I said, you can post your questions. Anyone who has any specific questions, that wants to go over them in a little bit more detail, you can kind of set up a consultation with me. The URL is movesmartly.com/meetjohn. If you had any questions that are a little bit more personal, again, a lot of these decisions about buying, selling, and when are as much about the market as each person's personal circumstances. So if that's helpful, you can kind of click the link there. Moving forward, a little bit about sort of the market for low-rise homes. So when we look at the number of sales for houses, they are down about 30% over last year. And again, for August, we are at basically a 20-year low in terms of the number of homes that are selling each month. And we've been at a 20-year low since May. So sales are very, very low in the Toronto area. New listings are roughly in line with last year, but well below historical norms. When we look at the low-rise market, about 6,000 homes got listed. Usually it's around 7,500. So we're seeing relatively few new listings come in the market. And the number of active listings is actually declining. And again, this is a typical, I'd say, seasonal trend as we move into August, but not the trend we would have expected given that sales are so low. Again, 20-year low, we would have expected inventory levels, the number of active homes for sale to kind of plateau, but they've been trending down since June. And we're going to chat a little bit about what's happening there. Now, the months of inventory, which is an important metric because it is a measurement of the balance between supply and demand. So when we talk about the months of inventory, imagine there are 100 homes available for sale at the end of the month and 50 homes actually sold that month. Well, the months of inventory is just 100 divided by 50, which is 2, and that's a very competitive market. If 20 homes had sold, we would have 5 months of inventory. So the 100 active listings divided by the 20 sales would be 5 months of inventory, which is a more well-supplied market and a far slower market. So inventory levels declined from just under 3 months to 2 months because sales picked up. And I didn't chat about that earlier. Sales actually picked up between July and August, which is not a typical seasonal trend, but we're seeing buyers re-enter the market. And active listings are down. So the combination of those two has actually made the market a little bit more competitive in August compared to July. Very few homes getting multiple offers right now. And average prices are roughly in line with last month. They've been basically falling since February from the peak of just under 1.7-ish million Average prices now are about 1.3, and they're down about 1% over last year. So we're down quite a bit from the peak, but again, we're seeing a little bit of stability over last month. Now, when we look at the condo market, slightly similar dynamics. We're seeing, again, very, very low volume of sales. Again, 20-year low for condo sales for the fourth month in a row. So very soft market. But unlike the market for houses, new listings are relatively in line with historical trends, I'd say. We did see a big spike in new listings in 2020 because a lot of people, investors in particular, were exiting the market in 2020 because condo prices and condo rents were plummeting. But if we look beyond 2020, new listings for condos are pretty much in line with historical trends. And the number of active listings, again, for condominiums is relatively good. I mean, compared to 2019 and 2020 levels, we're well above kind of historical norms. You know, we normally have close to 4,800 or 4,000 active listings. We're over 5,000, about 5,600 right now. So active listings for condominiums are quite decent. But much like the low-rise market, we saw the months of inventory drop a little bit for the condominium, not quite as much for condos relative to houses. And that's, again, because sales picked up a little bit and the number of active listings declined. And when we look at prices, again, we're kind of seeing a little bit of stability in prices for condominiums. Average price at $730,000, still down from the peak of $840,000, but up slightly over last year. Still, condos haven't fallen quite as much. So that's a little bit about some of the monthly stats. But when we kind of talk a little bit about on the ground trends we're seeing. What we're starting to see, quite frankly, and the August statistics kind of line up with some of the trends that we've been seeing on the ground. And there are a couple of trends. Number one, we're seeing buyers re-enter the market. I mean, and this is a normal, I guess, seasonal dynamic where a lot of buyers hit pause in July and August and they re-enter the market in September. We didn't know how many would jump back in because of course, high rates, a lot of economic instability. And again, falling prices. And so we weren't sure how many would jump back in, but we're seeing buyers jump back in. And in fact, many started their search a little bit early at the end of August rather than September to take advantage of the slow market, which is why sales were actually up in August over July. So that's the one trend we're seeing. The other trend we're seeing is a very, very tightly supplied market. Not a lot of listings, a lot of sellers canceling listings and being very patient. So the market appears to be plateauing and prices appear to be plateauing. And the best place to look at that is actually when we look at in rapidly changing markets, it's very helpful to look at weekly statistics rather than monthly statistics. I mean, in a normal market, we don't need to look at stats weekly, but when the market's changing as rapidly as it has been in Toronto, it helps. And when we look at weekly stats, you know, we basically see from February pretty much a straight line down from, you know, average prices in February about 1.7 million for houses. And every week they were kind of plummeting down until they hit about 1.3 million at the beginning of July. And since then, prices have plateaued a little bit. And again, this is kind of what we're starting to see on the ground. And I suspect that's probably going to kind of move into the fall market, but I'll chat about some of the reasons why I think that's going to happen as we move forward. So I think the first thing to chat about, and I think it really helps us understand some of the dynamics, again, like I said, is talking about how high interest rates alone are not why Toronto home prices are down 23%. So the median price for a home in Toronto has declined, like I said, 23%. And I think the reason why a lot of people, the justification, the explanation most people give for that is the fact that interest rates have cooled demand. And this is the reason why prices are falling. And I think to understand, certainly interest rates matter, of course. Interest rates are likely one of the big reasons why demand is at a 20-year low. But declining demand doesn't always result in a rapid decline in prices the way we've seen. And to understand this, I think it helps to hit pause to understand how housing markets normally cool down. And when housing markets normally cool down, typically what happens is demand slows down the way we've seen. Usually inventory builds up, right? Sellers are a little bit more patient. More homes start to sit on the market, and eventually prices actually stick for a while. They don't actually decline. And this quote from economist Carl Case, I think, really unpacks this. And he says, another important aspect of housing market efficiency is that prices tend to be sticky downward. In most markets, when excess supply develops, prices fall quickly to clear the market. But housing downturns have been characterized by sticky prices. Sales and starts drop, but prices are slow to respond. So when he talks about, prices falling quickly to clear the market, I mean, if you think about the stock market, when there's an abundance, there's no abundance of inventory in stocks. Like prices respond instantaneously when people want to get out of the market. There's no buildup of inventory. And that's what he means when the market clears. Whereas with houses, the housing market responds very differently. Inventory tends to build up. And, we have to ask ourselves, well, why does inventory usually build up? And there are a lot of reasons for this, but one of the big ones, of course, is loss aversion. When a home seller is listing their home for sale, they see that any price that they accept that is less than what their neighbor got at the peak as a loss, right? And sellers don't want to lose money. They want to get what their neighbor got, even if that was at the peak of the market. So they're more patient and are willing to hold out. So in most markets, sellers will just wait for the right price and not sell and kind of hold on. Now, that is, again, how most housing markets cool down. Prices stick for a while. And then eventually, when there's too much inventory, we start to see prices decline, right? So we see this cycle of buildup of inventory, prices sticking, and then at some point the inventory is just too great that sellers start caving in and prices start declining. So the question, of course, is, well, why the heck didn't prices stick in September or in the spring of this year when prices fell 23%, basically in 6 months? And the reason prices didn't stick and the reason prices fell so rapidly is because pretty much everyone who was listing their home for sale had already bought a home, and they needed to sell their current home in order to be able to complete the transaction of the home that they just bought. And they needed to sell at any price. And so in many ways, they were kind of like distressed sellers who could not just stick to their price and be patient. They were basically forced into a sale, even if it was less what they were budgeting for. And this is the reason why prices plummeted so quickly. And so that is an important dynamic. I think it's important to keep in mind. And yes, of course, interest rates were a big contributor to that in the sense that they pulled demand out, but it did not explain why sellers were so eager to dump their homes, which is pretty much what they did. And a lot of that is because in Toronto, historically, people buy their home first and then they sell their current home, right? But when you do that in a market that's very slow and demand's plummeting, you're in a tough bind. You have to sell your home at any cost. And that is mainly why we saw such a rapid decline. Now, the next question
John, how much of that was magnified by the fact that we saw peak prices, record prices in February? So the idea of a market in which people buy first because they were afraid of not being able to find the home they want and then sell, suddenly reversing, is that when we see generally the greatest price drops as soon as that switch happens?
Yeah, 100%. And this is, again, people buy first and then sell in Toronto because, normally it's really hard to buy a home. It's very competitive, and this past year has been unreasonably competitive. But even in a normal market, it takes time. Like homes get multiple offers. It's a slow process. It's hard to buy. It's usually very easy to sell. Like, homes sell relatively quickly. And this is why, buyers tends to buy first and then sell. But to your point, and this is why we saw this rapid turnaround. And this is actually almost exactly what happened in 2017. In 2017, we also had a bit of a rapid acceleration in prices that peaked in the first 2-3 months of 2017. And then when the province announced their foreign buyer tax, it spooked buyers, it spooked sellers, and prices fell quickly in 2017 for the exact same reason, because many of the people who had listed their homes for sale needed to sell and they had no choice, and they had to sell at any price, and they were willing to drop it quickly and adjust their expectations quickly because they had no options, right?
And is it fair to say then as well that was a bubbly market that suddenly
Yeah, it was
turned?
definitely a
And
bubbly market, right? And
so they had bought at a high price as well, compounding the difficulty in getting the prices they needed.
And the market turned very quickly. And I think that's the other point. Like, it was very rapid back then, and the turn in the market right now is very sudden. I mean, we didn't expect it. Like, I did not expect demand to plummet as quickly as it did in February and March. I think most people didn't, but I don't know, buyers got spooked. They were worried about interest rates, and buyers just quickly pulled out of the market. So
I'm curious, John, if you can tell us in your own practice, what do you look for? Because obviously when it starts to turn and you're caught out, you realize what's happened. What do you look for in terms of advising your team, advising your own clients about when you might want to switch that buy first, sell, and then switch the mentality and make sure you sell first and then buy?
That's a great question, because we experienced that. We started to see the early signs of it in February, quite frankly, the end of February. I wrote about the market cooling down in my March report. And the first signs are fewer showings, fewer offers, not just on our listings, but the listings our clients are bidding on as buyers, the ones that we're keeping an eye on. When you see homes that normally would have received 10 or 15 or 20 offers suddenly only get 4, it's a sign of the market turning, right? And even in February, March, we were telling our clients who needed to buy and sell to maybe consider selling first. I mean, most didn't. They all, their transactions turned out okay, but the challenge is, I think most people don't, and we don't know necessarily how quickly the market's going to shift, so we want to be cautious. So like, maybe you should sell first in March because it looks like the market's cooling down. But even in those moments, we don't know how quickly it's going to cool down. We didn't know how quickly prices were going to fall. So again, we caution most of our clients. Most of them still bought first, but we were very quick to list their home. And they sold fine. But you have to be very mindful of these dynamics when you're making these real-time decisions, because the risks are usually apparent before you buy. You know what I mean? So all of our clients were not surprised when they listed and showing volumes were down, because we told them that's what they should be expecting, right? So you do see the signs on the ground earlier before that's in the data.
And we have a question from our viewer, Naipal. Back to that issue of the sellers that were sort of caught when it turned in that period after February. The question is, those sellers that were selling off, could it be that they bought at the start of the pandemic and the rise in the interest rates were already affecting their ability to afford their payments due to inflation?
So I don't think that was
really the story. Yeah, is that really
no, I don't
the story?
think so. I don't think so, because if you bought a home in February, for example, right, you've secured a mortgage rate, like you got your financing commitment shortly after you bought, and you've locked in your mortgage rate, right? Like your more, and even if you hadn't, if you got a rate then, you would have had a rate hold. So that was before rates really accelerated, right? So and even the people that were buying, quite frankly, in March and April, many of them did not have to pay the much higher 5-year interest rate, which is, basically 5% now, because many of them had rate holds from February, right? So they were still probably, I don't know exactly, probably like the 3% range or mid threes or something like that. So even the buyers for buying in March, April, and maybe even May did not have to pay the much higher interest rate on 5-year mortgages. So I don't think that wasn't the big issue, right? Variables, sure, gradually they went up over time, and it may have impacted some people, but I don't think that wasn't why people were distressed. They were distressed because they needed to sell their home. You know what I mean? Like the financing.
Well, because they had bought. So it was more the issue that you described earlier. They had bought at a peak.
Yeah, exactly. They were at the peak, and then they're selling at a time when there are far fewer buyers, right? Now, I think Go
And
ahead.
sorry, John, can you also clarify the reason these buyers are in such a rush? They have to sell, even if they start to see prices far lower than they wanted, is because they run the risk of sort of backing out or defaulting on their buyer purchases.
Yeah, defaulting. Now, a lot of buyers have heard of like bridge financing where you can bridge two homes, like you bought one and you're still selling your current one and you can kind of bridge those two dates. But what a lot of them don't realize is to get a bridge where your closing dates will line up, you have to have sold your current home, right? So it's fine to own two homes for a month or two because the closing dates don't overlap, but you can't get a bridge financing loan if your home is still actively listed for sale, because the bank assumes you want to own two homes, right? Your home has to have sold for you to bridge that gap, right? And that's kind of why people were under pressure to sell. So when we think about the dynamics right now, I think we're hitting this point where prices are starting to stick. We're starting to see that if we think about sort of the weekly stats where I talk about prices have plateaued since July, partly because the sellers in today's market, for the most part, haven't bought yet. The trend of buying first and then selling has changed because people are seeing all the uncertainty in the market. So most sellers today are listing their homes first. Once it sells, then they start looking at buying a home, right? So there's quite a bit less distress among sellers in the market. And I think that's one of the reasons why we're seeing a little bit of plateauing in prices and potentially sticking in prices, right? And again, the thing that we're going to be thinking about, if we start to see a decline in price in the future, I don't think it's going to be as rapid as we saw in the spring, because most people today are not buying and then selling their home. They are listing and then selling. They're listing and then buying. If we see a decline, we're going to probably have to see a buildup of inventory first, right?
And do you think, John, going back to Naipaul's question, would that future buildup be more related to the interest rate rising and those other factors?
So that the buildup of inventory, if it happens in the future, could be a combination of a number of things. It could be a combination of just, again, demand staying low, but also you have to have more people selling, right? And you may have more people selling who, for example, are investors with multiple investment properties. They haven't sold yet because many of them haven't been impacted by higher rates, right? But if you have to refinance your home, or if you have to renew your mortgage, you're paying 50% more on your mortgage payment, and you have 3 investment properties, that could hit your bottom line. You could start seeing some investors selling because they can't handle the debt load, right? So that's and there are many reasons, and there are a lot of potential scenarios where people might starts to sell a little bit more quickly. So I think that's kind of one of the dynamics we're seeing, and it's not just, we're actually seeing it on the ground. If we look at sort of the statistics a slightly different way, I'm going to kind of unpack what I mean by that. So one of the things is, again, since May, we've seen a 20-year low in sales. And as I talked about at the beginning of this discussion, inventory levels are still low. 2 months of inventory for houses is a seller's market, right? It's competitive. It is not like there are still bidding wars going on today, right? The prices are not as irrational as 6 months ago, but there are homes with 5, 10, 12 offers, right? So the question, of course, is why are so few homes available for sale? So at the beginning of the discussion, I talked about how new listings, especially for low-rise homes, are quite low, right? But that alone doesn't explain what's happening. So one of the things I wanted to look at is, what is going on with the listings that are coming on the market? Are the sellers selling their homes, or are they simply canceling their homes and taking them off the market? Because this is something that we've observed sort of anecdotally here and there. Some sellers canceling their listings, some sellers just renting their homes out. So I wanted to kind of quantify to see, well, to what extent is this actually happening? I mean, we've been observing it, just by looking at the listings that we look at on the ground on an individual basis, but I wanted to kind of put some numbers behind it. So to do that, what I had to do first is look at how many homes were listed for sale between May and July of this year, I actually looked at, back to 2017 as well. But, for now, we'll just say how many homes were listed for sale between May and July this year that were no longer available for sale by the end of August. I wanted to give a little bit of time for some of these houses to kind of clear, sell, or cancel. So we're not interested in the homes that were actively for sale. We just wanted to know, out of all the homes that were listed for sale in May, June, July, how many were no longer available for sale. And these are the number of listings. And I should add here, these are unique homes. A lot of times agents will take the same home and list it multiple times, and when they're changing the price, or if it's taking a long time to sell, this gets rid of that. We're counting basically unique or distinct sales. And this is kind of what we're looking at. So when we're looking at the low-rise market, there were about 18,000 homes that were listed for sale, which is kind of well below, or a bit below, the 20 to 22,000, which we would normally expect. Whereas the condo market had about 11,000 listings, which is, roughly in line with historical norms. So then the next question, of course, is, well, out of these homes that were listed for sale between May and July that were taken off the market or no longer available by the end of August, how many of them sold and how many of them were actually canceled? Canceled meaning the seller didn't sell it and they just took it off the market. So when we look at the number or the percentage of these listings that were actually canceled, we kind of see some interesting trends. This year, 2022, the number of low-rise listings, or the percentage that were canceled, was 39%. And this is well above the historical trends, which were probably anywhere from, 16 to just over 25%. So 39% were canceled, which is actually relatively close to what we saw in 2017. And kind of going back to the discussion we had about 2017, I wanted to include 2017ers because the price dynamics we saw in 2017 for low-rise homes are very similar. We had that bubble in the first quarter, then prices plummeted, which might help explain why so many sellers were canceling their listings. So a lot of sellers, nearly 40% of low-rise sellers are canceling their listings. When we look at the condo market, this is where it's even more interesting, I think. About 45% of condo listings were just simply canceled. And this is well above the 20 to 22% or 25% that's more typical. So a lot of condo owners are just taking their units off the market. Now, what are they doing with them, I guess, is the next question, right? And so to figure out what they're doing with them, I wanted to see, okay, well, what share of these canceled listings are being rented out? Because this is something that we've definitely, again, have seen on the ground when we look at listings that our clients of ours are interested in. We'll see that it got canceled and rented out. So I want to say, well, how many of these are being canceled? So when we looked at that, we kind of saw, again, interesting trends. So when we look at the low-rise market, only about 8% of homes that were canceled on the low-rise market were being rented out. It's still above past trends, but it's relatively low. Whereas the condo market, just under 25% of the listings that were canceled were actually rented out, right? And the question here, of course, is, well, why are these things happening? Why are so many sellers canceling their listings? And I think the dynamics for the low-rise and the condos are slightly different. When we think about why low-rise sellers are canceling, those are disproportionately end users, family homes, people who are just listing their family home for sale, trying to sell it so they can buy their next home. Those are likely just the sellers who are patient on their price. We talked about that earlier, sort of prices sticking a bit, being a little bit more patient, not rushing to just sell it at any price. I think those are the dynamics that are driving the number of canceled listings in the low-rise market.
And John, if I could just jump in there,
yeah.
Just because of the jargon, low-rise here, you're referring to not low-rise buildings, but you're referring to houses.
I'm referring to houses, yeah. Thank you. By low-rise, I mean like detached homes, semi-detached homes, and townhomes. Not condo townhomes, not condo apartments, just low-rise single-family homes. So that is, I suspect, the reason why so few are being rented. Some, of course, are because they're just, some people are just moving out and can afford to hold on to it and just rent it out and not sell it. But disproportionately, there are end users who are trying to sell their home and probably just upsize or downsize, aren't getting the price they want, and are just canceling the listing. Whereas in the condo market, condos are disproportionately driven by investors. A lot of investors own condominiums. And in that market, they're seeing that the market is soft for selling, but booming for renting. So just renting their units out, and they're hitting pause. And I think those are the dynamics that I think are partly leading to sort of the stickiness in prices, both for condominiums and for houses right now. So again, like I said,
John,
go ahead.
Sorry, just as a question again about how these things are counted. When you say condos, do you mean primarily condo apartments, or are you including condo townhouses, for example?
We include condo townhomes and condo apartments, but the vast majority are condo apartments. Condo towns are a much smaller percentage of the total condo pool. So again, I think these are the dynamics we're seeing right now. I suspect these are the dynamics that are going to carry through to the fall. I don't expect any rapid decline over the next couple of months. The market, I think, is going to still stay tight. But again, the things that we're going to be looking out for are increases in inventory, a little bit more distress among sellers. Any seller, and I've tweeted about this recently, any homeowner who got a mortgage from a private lender or a secondary lender, so not a big bank, because their credit wasn't as great or whatever, those mortgages tend to be 1 and 2 year mortgages, which means a lot of those people will be renewing today at much higher rates. And many of them are going to have a hard time paying those significantly higher mortgage payments. So, as we move into the new year, you might start to see more people selling because they have to, right? Because they can't afford the payments on the mortgages that they have. So again,
Great, John. And you're touching on a question that a viewer, Alex, had. When do you think inventory might go up? Are you thinking that might be the first time?
I think it's possible. I think if we start to see it in any material, amount, I suspect it's going to probably be in next year, like maybe the end of this year. But I think the market is still a bit too competitive right now. But we might see a buildup as we move to January or early January. If we see another, 75 basis point rate hike next month. I mean, it's hard to say, but again, I think we can see it. That's a key thing. It's not like we wake up one day and there's more inventory. You see the inventory gradually building. And that's kind of why I like doing these monthly webinars, because every month we're going to be looking at slightly different statistics, and we'll see how the momentum in the market is changing from one month to the next, right? And that's
out of curiosity, sorry, yeah. John, out of curiosity, that figure that you showed where you kind of scrub the data to sort of isolate the unique listings, is that generally how the stats are reported by real estate boards? And when media reports on, for example, the number of new listings, do they count multiple new listings in there for the same house or same condo?
Yeah, no. So and that's why I had to do this analysis, because the real estate statistics put out by the boards will double count listings. So if an agent lists the same home for sale 3 times in the same month, that counts as 3 new listings, even though it's just one home, right? So that's why the new listings count sometimes are a little bit misleading, which is why I wanted to kind of.
And does it get more inflated when prices start to fall, when sellers aren't getting what they want, when the market starts to slow?
Exactly. If you think about it, in a market where homes are selling quickly, you don't have to list the same home 4 times and change the price 4 times. They sell basically right away. So that, again, is another example of a market that is cooling down, right? So those are the things we're going to kind of keep an eye on. And the last thing I want to touch on, which is actually related to this entire discussion, and someone on Twitter had asked me about this question. So in the past, I had talked about in past reports on Twitter that housing markets that are very, very dominated by investors tends to be more vulnerable when the market starts to cool down, right? And the housing markets are more vulnerable to a big decline because investors are more quick to exit the market, to list their properties for sale, to get out at the first sign of trouble. And they do that because they're not attached to their properties. I mean, it's just a business decision to sell at what they think is the peak. Whereas a family is not going to rush to sell if they think prices might fall tomorrow. No one's going to, take their family out of their home and go rent to try to time the market. And the question, and we saw this in the US during their bubble in 2006 and the financial crisis. The states in the US that saw the biggest decline in prices were the ones dominated by investors. We saw this in Toronto in 2020 when the condo market, both prices and rents started to fall. In one of my reports, I showed that the big surge in the number of new listings was actually largely driven by investors who were exiting the market, right? So the question, of course, right now is, well, why aren't investors rushing to sell right now? Why aren't they rushing to sell? And the question, and the main answer is that in 2020, when they were rushing to sell, there were two things going on. Both prices were falling and rents were tanking, right? Whereas today, prices are definitely cooling in the condo market, but the rental market is on fire, right? And this has fueled a little bit of optimism for investors. Many of them have a lot of equity in their condos. They can afford to hold on to them. And when they see the prices for condos, I think I wrote in the report, are up something like $450 in Toronto in 1 year per month, like 20% increase. This has made investors feel a little bit more optimistic about the future path of both rents and condo prices. So many of them are just holding on and not rushing to sell, right? Now, like I said, these are the dynamics today. This could, of course, easily change with investors who are very highly leveraged. And the market, quite frankly, that is relatively vulnerable is the market for pre-construction properties, because many of these investors, and we're seeing this on the ground right now, and there's no great data for it, but a lot of investors are trying to assign their condominiums and the houses that they bought. So an assignment is basically when you've bought a property pre-construction, you don't own it yet, but you're trying to flip that contract, right? And in the past, this is very common in the past, investors would try to do that at a profit, expecting to make a return. They never even take possession of the property. They just sell the paper contract and make $100,000. Well, today, investors are trying to do the same thing, but there's no appetite for assignments. And many of them are potentially even trying to assign at a loss. And the reason is, probably a lot of reasons, but one big one is it's a lot harder to get a mortgage today, right? Buyers are, and investors are being stress tested at 7%, not 5% anymore. Rates are much higher. It's a lot harder to carry it when they look at their cash flow on that. They're going to get a rate that's today's rates, right? So many investors don't want to close. And this is where we could start to see, again, a little bit more distress, because a lot of these investors who bought pre-construction condos, not all of them, some of them have a lot of capital, but many of them are highly leveraged. They took their deposits out of their home equity line of credit. It's a lot driven by debt, right? So this is the segment of the market where we could start to see some issues in the next 6 to 12 months if pre-construction investors have a hard time taking possession of the units. Now, again, I don't know how big of an issue this is going to be, especially for projects that were bought 5 years ago. Many of those investors in those units have probably gone up in price. So it's not like, the investors are going to be underwater. But it is certainly an issue for units that were bought more recently, even low-rise houses. If someone bought a low-rise home pre-construction a year ago, that could be worth well below what they paid for it today. So these are some of the dynamics we're going to be keeping an eye on as we move into the next, 6 or 12 months, with respect to sort of how investors might be impacting sort of the markets on the ground. So I don't know if
John,
we have
one
any.
thing
Yeah,
we do. One follow-up I had in your report, I really I felt the distinction you were making with investor behavior in terms of, first, it's the feeling, how optimistic or pessimistic you are about what's going to happen. It seems like the next phase you're suggesting from your report will be actual people not being able to get the mortgages so they can actually take possession of properties they've only made deposits on to date. And going back to that question of the first phase, how much mood matters. Do you think that in the early part of the pandemic, when rents started to plummet and people were negotiating lower rents, is it possible that condo pessimism was overstated then? Is it possible that anybody exited the market, perhaps not seeing this surprising reversal coming only, right on the heels of that same period of the pandemic.
Yeah, 100%. And that's a great question. So when people exit at the beginning, it's very behavioral. Like it's all based on people's pessimism, right? And you're right. It was amplified at the beginning of COVID because people were leaving the downtown core, condos were emptying out, rents were plummeting, tenants were renegotiating the rents down. It was a very pessimistic mood back then. And a lot of condo owners were just dumping their units because they were worried things were just going to get worse and worse, right? And you're right. We've passed sort of the pessimism point in the market, because even though prices have fallen, I think a lot of investors aren't pessimistic because rents are booming, right? There's so much demand for housing. And I think right now, you're right. The next cycle, if we see investors impacting the market, are the investors who are distressed, and I'm meeting with, interestingly enough, the IMF next week to kind of talk about these dynamics. I met with them like maybe 6 months ago, because they're also concerned, obviously, about what is going on and some of the potential systemic risks in different housing markets around the world. And they're analyzing Canada right now. And certainly, a disproportionate number of investors in the condo market can create a lot of instability in periods precisely like this of rapidly rising rates when people can't afford them, right? And they can't afford to close on them, and they can't afford to take a mortgage. Well, what happens in the market if that happens? We're still early. And I think, again, the risks, and I've done a few videos on sort of the cycles that we're seeing in the market and some of the big macro trends on our YouTube channel. But I think the point is that, the risks get amplified the longer inflation is high and the longer interest rates are high, right? If the Bank of Canada can kind of put inflation on a downward trend sooner rather than later, I think the systemic risks might be mitigated. If we have 5 to 6% interest rates for the next 2.5 or 3 years, I mean, this is potentially very problematic especially for the pre-construction sector of the market. So
you also had an interesting section in your report on how similarly business and consumer expectations around inflation have just the belief has such an impact on what might happen with real estate. So I invite everyone to read that full report. If you want to access it, it's at our website, movesmartly.com. And the videos that John is referring to are at our Move Smartly YouTube channel. So you can find them there. I think we might end, I know we're coming close to our time, John, on a great question from a viewer, Zaid. And I think Zaid's touching on something that I know you and I have started to discuss at Move Smartly, which is the idea of whether inventory in the low rise or the house market what would the magnitude of that increase be if there was a surge? Like, is there really a risk? You talked a little bit about some people in specific situations that have maybe gone to private lenders earlier, perhaps needing to list their properties. But Zaid asks, so much of the low-rise market are represented by owners that have built up quite a lot of equity if they bought in the last decade or so, where we've seen an incredible run-up in prices. So really, is there any way to get at this magnitude or this potential for suddenly many houses to come on the market?
Yeah, that's a fantastic question. And we got to think about, like, in the low rise market, the fact is Toronto is so undersupplied of low rise family homes. When we think about what we're building, we're largely building condos. We're not building many houses. And it's one of the reasons why the low-rise market really exploded far more than the condo market. So it's very hard to say, because I think this is the key thing too, even when households are stretched financially or a little bit distressed for a while, people do not just leave their home and sell it, right? Like people will rack up credit card debt to pay their mortgage. They'll do everything they can to hold on to the home before they move out of their home, right? And so this is why I said we'd have to have high rates for a long time for you to start to see a lot of distress in the market. And I don't know how much we're going to see it in the low rise market. And again, it's a function of how affordability, how much demand there is out there, and if we start to see a little bit of distress from some households. But again, it's hard to say. I don't know if we're going to see this sea of defaulting households that needs to sell their home the way we saw in the US. And again, it's hard to say because a lot of this data on secondary debts and mortgages and private lenders is not public. So we don't know exactly the number of households that fit that category. But again, we're going to see, if that starts happening, we start seeing the dynamics on the ground pretty quickly, right? We start to see inventory building up. You start to, as you're talking to clients of your own who need to sell, or sellers of the buyers who need to sell, they'll tell you they need the situation. So you kind of start to hear it anecdotally. And quite frankly, a lot of the research I do is, it's almost like the anecdotes and the on the ground lead me to sort of look at trends in the data to sort of quantify it. So we see things on the ground first through anecdotes and word of mouth. So we'll be keeping an eye out for that for sure.
I guess that was a big lesson from The Big Short. So you're just doing that.
Exactly.
that big lesson. And I know more formally that is the branch of behavioral economics, which is starting to try and pay more attention to how behaviors shift markets as well, and tell us perhaps before the data does. Now, we have a good question from Adriano about perhaps another factor that might come outside of the housing market. Do you think if the employment numbers, if there is some kind of, I think this has to do with loss of employment, because Canada is now predicted, and the US as well, to enter a recessionary cycle, could loss of employment lead to a flood of new listings?
Yeah, no, 100%. I mean, this is actually usually the difference between a housing, slight correction and a housing crash. Like, usually crashes are often tied to periods of high unemployment. And I think this is actually a good point. I'm glad the question came up, because we've just been talking about mortgages and debt or whatever, but these higher mortgage payments, all of that starts becoming a bigger problem, even if one person in a household is unemployed for a period of time, right? And unfortunately, this appears to be the path that the Bank of Canada and central banks are on. In Canada, banks are not as direct about that. Economists are not as direct about that. But if you follow sort of the US market, a lot of economists are very blunt about the fact that they need to get unemployment. They need to get unemployment up to cool inflation, right? So the Canadians are not as blunt about that or direct. And I think this idea of a soft landing is unlikely. So we'll likely see unemployment numbers go up. And certainly that can definitely lead to distress, which, I think the next question we have here, of course, is it a matter of if or when we'll see increase in inventory? That's 100%. It's a great question. It's a function of all of these things, which is hard to predict. You're right. Unemployment is still low. You know what I mean? So again, if inflation stays high, rates stay high, the likelihood of high unemployment increases, the higher likelihood of distressed families increases. But we're not going to know, obviously, for another who knows how many months. But these are obviously important dynamics we need to keep an eye on.
Yeah, a worrying time, and it's very perplexing. So it's very useful to have you unpack some of these trends for us, because obviously there are so many factors, and I think some of us are anxious. Many are anxious. We're definitely entering a new time, and the way you've broken down other trends, little trends, micro trends, has been super helpful. So I think that's our time today. Is there anything that you're thinking that you're going to be talking about or looking at as you head into your next report cycle?
I have no idea. It's like I said, it's always driven by what I'm seeing from week to week. So we're going to kind of keep a look at some of the trends we're seeing in the dynamics. So I don't know from now. It's still a little bit early, but obviously a lot of the things that we talked about, we're going to be keeping an eye on in terms of listing volumes and the balance between supply and demand, and see how inventory is changing. And we'll look at that kind of real time. And for those of you who jumped in a little bit late, you'll get a link with a recording to view it after if you want, if you couldn't join the whole session.
Absolutely. In fact, you can use the same link that you used to enter here. As soon as the event's over, you'll start to see the replay. We will also be adding a YouTube version with timestamps shortly. And we thank all of you for joining us. And again, if you need any more information on the reports and other events we've mentioned. MoveSmartly.com has a lot of the information and a lot of John's analysis there. Thank you.
Thanks, everyone.